The once mighty US dollar, a symbol of economic dominance and stability, is now facing a dark fall. The culprit? Reckless money printing and the subsequent devaluation of the currency. As the Fed churns out dollars at an unimaginable rate, the repercussions are becoming increasingly evident. Keep watching till the end to explore the alarming trend of the diminishing value of the US dollar, its potential replacement as the primary global currency, and the dire consequences of eroding purchasing power. The genesis of the dollar's fall from grace can be traced back to the insatiable appetite for money printing by the United States government. In an attempt to stimulate economic growth, particularly in the aftermath of the 2008 financial crisis and the more recent challenges posed by the COVID-19 pandemic, the Federal Reserve has engaged in an irresponsible level of quantitative easing. Look at this chart, for an instance. By 2020, the total M1 money supply of the USD stood at nearly $4 trillion. Just 2 years later, this number jumped to around $20 trillion. So effectively, almost 80% of all USD was printed in these 2 years. And that is the entire history of the United States that we're talking about. The consequence of this relentless printing of money has been a surge in the money supply, leading to inflationary pressures. While inflation is often seen as a natural economic phenomenon, the magnitude and speed at which the US government has been printing money are unprecedented. The alarming rise in inflation has begun to erode the purchasing power of the US dollar, hitting ordinary citizens' wallets and diminishing their ability to maintain a decent standard of living. Now, as the supply of money skyrockets, the value of each individual dollar diminishes. This, in turn, leads to rising prices for goods and services, creating a strain on households and businesses alike. The cost of living is on the rise, and citizens find themselves needing more dollars to buy the same basket of goods they once could with less. This erosion of purchasing power disproportionately affects those with fixed incomes and savings, jeopardizing the financial security of many. Look at this chart for reference. After the stabilization of US as the global superpower, the recent spike in the inflation rate is perhaps the most volatile among the last 4 decades, with the rate of inflation going as high as almost 10%. To give you an idea of how high that is, a developing nation like India also targets to keep inflation at around 6%, and anything above that is a deterrent to their economy. Now wonder how grave of a situation would this be for the US dollar. Moving on, the devaluation of the US dollar has not gone unnoticed on the global stage. Traditionally, the US dollar has been the primary reserve currency, with nations and businesses around the world holding significant portions of their wealth in dollars. However, the relentless money printing has prompted countries to explore alternative arrangements for international trade. Bilateral trade agreements between nations, excluding the US dollar as an intermediary, have become more prevalent. Major economies like China and Russia have been at the forefront of this shift, conducting transactions in their own currencies rather than relying on the once unquestionable supremacy of the US dollar. This trend signals a major shift in the global economic landscape, with potential threats to the dollar's status as the world's primary reserve currency. For example, oil has been priced in dollars for decades, one of the few predictable relationships in a commodity market that can be very volatile. But there's a shift underway in some countries that is reducing the dollar's dominance. The most prominent country that has shifted sales away from the dollar is Russia, which accounts for about 10% of oil production. But Russian oil no longer flows to Europe or the US because of sanctions related to Russia's invasion of Ukraine, and an increasing amount of its oil has gone to India and China. Other countries that have been sanctioned by the US have also shifted the currencies they use. Venezuela, which has the most oil reserves in the world, started using the Chinese yuan or the euro for its oil trades following the imposition of US sanctions. Overall, about 20% of the world's oil is now being sold at discounted prices because of sanctions. Much of that trade has moved away from the dollar, or at least has the potential to do so. Another interesting aspect of currency printing is the amount of gold kept as a backing. A historical perspective sheds light on the significance of gold reserves as a defense against currency devaluation. Traditionally, the US maintained a gold standard linking the value of the dollar to a specific quantity of gold. This backing of the currency to a tangible asset provided a safeguard against the explosion of the money supply. However, as the world moved away from the gold standard in the 20th century, the ratio of gold reserves to dollars in circulation became increasingly skewed. The disconnect between the physical anchor of gold and the sudden increase of fiat currency was perhaps the first nail in the coffin for the erosion of the dollar's value. While the gold standard may seem like a relic of the past, its historical significance and ability to curb inflation cannot be dismissed. Economists believe that a careful reconsideration of the gold reserve to dollar ratio could serve as a safeguard against the devaluation spiral currently gripping the US currency. All in all, the anticipated fall of the US dollar as the global currency is a complex and multifaceted issue, rooted in the combination of reckless money printing, devaluation, and the erosion of purchasing power. As the world witnesses a shift away from the dollar-centric global economic order, the need for corrective measures becomes increasingly apparent. Addressing the root causes of the dollar's decline necessitates a critical evaluation of monetary policies, exploration of alternative trade arrangements, and perhaps a return to a more robust system of asset-backed currency. The repercussions of inaction are profound, affecting not only the economic stability of the United States, but also the global financial landscape. It is a call to action for policymakers and citizens alike to navigate these turbulent waters and salvage the integrity of a currency that has long been a symbol of economic prowess.